Good day, everyone. My name is Matthew Curtin. I'm a senior editor at Scope, and I would like to welcome you to the Scope Ratings webinar. The COVID-19 epidemic has made us all appreciate the importance of buildings in our lives, from spending much more time at home and much less, if any, in offices, airports, shops, restaurants, and theaters, all the way to the more subtle appreciation of how important warehouses, logistic hubs, and data centers have become in the modern economy. With sustainability also at the top of policymaking and investors' agenda, the pivotal economic role that real estate plays is even more in the spotlight. With this in mind, it is my pleasure to welcome Philipp Wass, Executive Director at Scope Ratings, back for another real estate webinar. Philipp, who heads up one of our most important corporate credit rating franchises at Scope, is going to guide us through Scope's view on the most important environmental, social, and governance considerations for the sector. Philipp's going to talk for around 20 minutes before answering questions. If you have questions at any point during the webinar, you can type these in the chat window on the right-hand side of the screen. We'll collect them and answer as many as we can right after.
So I assume it's now with me to take over. I guess we lost Matthew during his introduction. Also, a warm welcome from my side on today's presentation on ESG considerations for credit ratings of real estate corporates. Maybe just to start with, credit rating analysis remains focused on credit quality of companies based on their business and financial risk profiles. So these ESG factors I will touch base on within the following minutes are only considered if they have an ubiquitously discernible and material impact on either the cash flow or the overall credit profile of the company. Of course, the impact of these non-financial KPIs that tends to be more of a qualitative nature is not so easy observable, especially not in the short term. Thus, so to say, to incorporate them, we do this on opinion-based basis. So if we look at actions that needs to be taken as of now, we just form our opinion on what will be the impact in the medium to long-term future, as most of these actions, as I said, will not directly lead to observable effects in the short term. And if you want to gain more insight on the factors we look at in assessing the risk and opportunities that a real estate company might face, you will find the link to the relevant publication later within the presentation. And I guess the presentation is also ready to be downloaded. So on the top right corner, I guess there is a little cloud symbol and you can download the presentation right away. So without further ado, let's just jump into the presentation. So as Matthew also introduced, buildings in which we live, work, shop, socialize and entertain are inevitably at the center of attempts to create a more sustainable economy and improve human well-being. And why is it so? Because real estate stock accounts for a major part of energy consumption and carbon emission. So both are forming parts, let's say, of the drivers of climate change. And furthermore, properties, especially those for residential spaces, represent one of the basic human needs. And if we look, so to say, at the main challenges the real estate industry is facing, we identified the three main interlinked challenges we list here. So the one is addressing, or the first is addressing the climate change. Second is improving sustainability, and third is adapting to regulatory change. And as I said, all these three are interlinked to some extent. So of course, if we see, so to say, the need for addressing the climate change, not only real estate corporates see that to literally weatherproof their portfolio against the climate change, but also regulators see that, and thus, so to say, they introduce regulatory frameworks. And the same applies to improving sustainability of buildings. So let's touch first base on the climate change. And here everything is about balancing the emission reduction with the needed capital expenditure. And why this is important, we need to firstly look at the status quo of the real estate industry, and as well as their contribution to the overall, so to say, effects that drive climate change. So you can see here that property stock in Europe accounts for roughly 40% of energy consumption and roughly 1/3 in CO2 emissions, according to the European Commission. And you might wonder, why are these numbers so high? Because we now define, so to say, real estate in a broader sense. So we look at the property life cycle as a whole, so including construction, operations, renovations, and demolition. Yeah? And as real estate industry plays a significant role in achieving, so to say, a more climate neutral portfolio, yeah, it is also essential in achieving the goal that has been defined by the Paris Agreement, yeah, to limit global warming well below 2 degrees Celsius. If this is possible or not, this is not what I'm here to judge for. But in the end, if the climate change is, so to say, accelerating, what we risk is stranded and impaired assets. So it's not only about the frequency that is slightly higher if it comes to natural hazards, but also about their intensity. And especially what is of risk is that humankind actually expanded its foothold and its habitation into risk areas. So where we have naturally more natural hazards. Yeah? So we live now near coasts, in forests, etc. pp. So that increases the danger for properties. Okay, so we know now real estate has to play a significant role in achieving the goals. And the main pitfalls actually in achieving that are fourfold. So the most important one, yeah, is the investment needed. So we estimate that it needs in between 225 billion euros up to 600 billion euros a year to actually refurbish the property stock of all over Europe to achieve the climate goals, yeah, by 2050. And to put it in other words, it's roughly 1 to 3% of the European GDP we have to spend on the European property stock to really achieve carbon neutrality of that. Yeah, and to unleash the financing that is needed, it's a very huge amount of financing actually needed. Yeah? So up to 600 billion euros a year is difficult, if not impossible, especially if we look at, so to say, the second square presented on that slide. As of now, investments for most of the property stock do not pay off. What does it mean? So returns actually in cost savings, rent increases or subsidies are received, or the avoidance of penalties are mostly below the initial investments. And you might wonder, well, that could not be true. So if I walk around the city, I see a lot of cranes, a lot of, so to say, new properties that will be built, or a lot of refurbishments, and all of them are green, or at least they try to achieve the respective certificates actually that they can claim that they are green, or that they have a very sustainable foothold or whatsoever. That's true to a certain extent. So we have some bias if we look at the real estate industry and also at the property stock. So we look at or focus more on prime assets and locations, and also secondary locations. But the majority of the property stock is not prime. Yeah, so thus tenant demand is weaker, and the challenge is actually to share the transitional refurbishment costs with the tenants. Yeah, while the latter, so the tenants, do not show a high amount of appetite actually to pay significantly more in relative terms. So even a rent increase of 2 to 3 euros, yeah, could be a significant increase in occupational costs. And if you pay, I don't know, 10 euros a square meter beforehand. And the second one is that given the accelerated transformation with regards to the need for specific property types or spaces, yeah, leases, at least that is what we believe, will be shorter in the future. So the investors into these green buildings, or investors that finance, so to say, the refurbishment of buildings to become green and more sustainable and carbon neutral, etc. pp. They face either risk that they cannot get the profit, or if the tenant is willing to subscribe to a higher rent that generates some kind of profit for the landlord, it's not certain to a full extent that, given, so to say, the shorter lease contract, that in the end Yeah, so after the property's life cycle is over, the return is really there for the investor. And why is it so? So one of the hindering things in the real estate industry is the scale. Yeah, so most of market participants are small institutional vehicles or private individuals. So they mostly cannot afford investments into their portfolio, as they lack the diversification really to off balance, and stabilize cash flow if parts are undergoing extensive refurbishments. Because the smaller you are, the heavier the impact is on your overall cash generation. If you take a part out of it and refurbish it, and also are exposed to the risk of refurbishment and reletting or getting the rent you are requesting. And on the other hand, if you're small, you lack economies of scale if it comes to construction materials, if it comes to contracts with the construction companies, but you also lack sufficiently, so to say, diversified access to financing that really can, so to say, also provide some leeway in the overall investments needed. And last but not least, one hindering fact is the still existing fragmentation in Europe. Even if we see, so to say, there have been a lot of efforts in the European Union, at least, to say, uniform all the regulatory framework, etc. PP, we still have sort of the individual speed on transformation per jurisdiction. We have also the individual paths how to achieve the ESG goals. So every country does it a bit different to the next one if it comes to incentives, subsidies, legal framework, what to achieve. Second, we have also a variety of certificates. You now can pick as an investor the certificate that fits best to you, that let you shine in the brightest light, instead of, so to say, being really comparable or achieve comparability to other properties. Yeah, so some of the certificates focus just on the operational phase of the building, some of the whole, so to say, life cycle. So we have a great variety, and this is probably not good also from an investor's point of view because of comparability reasons. And one of the last challenges is that the regulatory incentives that are already in place won't influence the private non-regulated financing market that in Europe, at least for commercial real estate lending, makes up to 40% of the overall lending environment. Yeah, it's a tremendous increase from just 10% it has been prior to the global financial crisis. So we are now somewhat capped in between the two things. So we have the need to improve something, on the one hand. On the other hand, investments are huge, and actually the supporting elements are not, so to say, paying off. But still, from a credit angle, we have to look at this. And if we try to, so to say, describe how it is from a relevance for credit risk profile, what we do is really to assess the risk of a company it is exposed to if its portfolio is not resilient, to rising temperatures or other natural hazards. So this is more or less driven by the asset quality. So it could be steered by maintenance or especially, so to say, refurbishments, or via the location. So you can naturally have properties that are close to the coast. As I said, we expanded our habitation closer to areas where we are naturally more natural hazards. And this, so to say, will be a downside. And another thing we look at is if a company is able to comply with the targeted emission cuts. So even if we do not see immediately that it will pay off, we believe that in the future there will be more forceful regulation that will be put into place. And as such, so to say, companies have to tackle that issue. The question is how this regulation will be supported by, so to say, additional financing, subsidies, etc., PP, to make it also profitable. So the second big theme here is sustainability. And as we noticed already, real estate plays a crucial role, not only if it comes to climate change, but also if it comes to sustainable growth and fast-urbanizing cities or the fast-urbanizing world, as well as after, so to say, the pandemic that is still not over and still ongoing. And to shed some light on what we mean with that. So according to the UN, roughly 70% of the global population will live in urban agglomerations by 2050. And as I said earlier, humankind cannot relentlessly expand its foothold, to areas, so to say, that are more exposed to natural hazards, because then from a real estate perspective, the companies risk, so to say, impaired or stranded assets on the one hand, or on the other hand, have to pay much more to create a property that is weatherproof in the literal sense. So we have to find space within the existing boundaries of urban areas. The next thing, what is becoming more striking as we went through the pandemic right now, is the acceleration of change that was triggered by COVID-19. So we believe effectively that COVID-19 did not kick off any new, so to say, developments, but it accelerated the change that parts of the real estate industry was already exposed to. So not only because there's a change of space consumption or need. So if we talk about, okay, just the blunt schemes, retail will be less requested on the one hand, but on the other hand, logistics will become more important, or also data centers or the place for data centers or offices will need to have different, let's say, shape to attract, again, residents and tenants. And as such, so to say, there is a multitude of changes that have been accelerated by the COVID-19 crisis. But on the bottom, you see two squares where we see, okay, there's already something that happened. So we have an increasing focus on the property's life cycle, so including the upstream industries like building materials and construction, because they have been much longer been exposed to regulation that forces them to reduce greenhouse gas emissions or ensure a safe working environment. And on the other hand, we see literally an exploding request or investor appetite for SDG financing, so sustainable development goal financing that comprise green financing, social bonds, sustainability bonds. And if we just look at the increase from 2017 up to end of May this year, it has been a ninefold increase of issuances from European real estate corporates that are flagged to be SDG bonds. So in absolute terms, that's a tremendous increase already. You might say, okay, well, maybe overall there is an increase in debt issuance activity because we see ever rising price levels. It's a very capital intense business. More and more companies, so to say, go to capital markets to refinance or finance themselves. But also in relative terms, we see a strong increase. So up to end of May this year, those SDG bonds made up 30% of the total issuance volume of real estate companies, whereas in 2017 it has been only 3%. The problem is, however, that we still lack to see more favorable terms for green financing regards financing costs as well as covenants. So if it comes to the latter, they're mostly the same compared to normal brown bonds. They might be added by some additional covenants that are focusing on the company to achieving its sustainability goals. The same applies actually to financing costs. So if we look at generally SDG financing, incorporating also loans and also only bonds, we see that the reduced margin or the reduction in margin for green financing does not cover up the potential penalties if a company is not succeeding in, so to say, executing its move to sustainability. So in the end, green financing could become more expensive than, so to say, normal financing as of now. And this is especially true, so to say, for the smaller participants in the market. Of course, the larger ones, they have much better access to the market and could set the pace there. But for the smaller ones, we do not see, and remember the smaller ones made up the majority of the market, we do not see that green financing provides them, as to say, with the necessary incentives to really go down that route. So as of now, it's green bonds or green financing appears to be more a feel-good factor and somewhat like greenwashing. So, but overall, what real estate industry needs to achieve, the ultimate goal is to prolong a building's life cycle, just from a sustainability point of view. So it's not from an environmental point of view, a great thing, but also for the investors, because if I have a prolonged building's life cycle, I have an absolute high return on my investments because I receive cash flow for a longer period. The same is true for a credit perspective. Yeah, if I have to say a prolonged building life cycle, I can actually see that I have to invest less into recreating that property, so I have also a longer tenor if it comes to cash flows. I have more visible cash flows, more stable cash flows, all good, so to say, from the perspective of a credit rating agency. And to really achieve that, we have a few tasks that need to be fulfilled. The first one is actually companies have to improve their production processes regards construction, maintenance, refurbishment. So just using recycled or renewable material, to a greater extent also data for better resource management. And this is not only true for the construction phase or refurbishment phase, but also for the operational phase. And in the ideal world, in the end, we have something like a circular economy. So that means, to give you an example, if we demolish a property, we can use most of the racking material to build something new. And we experienced that some companies of the companies we covered in the building materials sector already kicked off such initiatives, so that they actually buy racking material, and just so to say, use that material to produce new building material for new constructions or whatsoever. So that is also, from a sustainable point of view, a great deal, as it lowers the cost and effectively, so to say, is more carbon neutral. In the end, if we look at the operational phase, I said data is also essential here, because if we have some smart solutions, we can actually have also better resource management. But what is much more important is, in the future, space efficiency and flexibility. So properties actually should be designed in a way, that they're easily adjustable to different kinds of use. So if it's office, residential, retail, whatsoever, as well as the varying space needs of tenants. And this all should be doable without extensive measures needed, so without extensive refurbishments needed. However, everything, so to say, boils down to the amount of money that is needed. All the parties need to be involved to reach these goals of sustainability or reducing greenhouse gas emissions or whatsoever, including debt investors. And they need to provide more borrower-friendly margins and covenants on a broader scale. As I said, remember the fragmented real estate world we are living in. And most of the participants do not have really strong access to financing, given the limited scale. And last but not least, something that became more and more important, or has been, so to say, switched to the top of the agenda, is the occupant's health and safety, as well as social equity. So what we mean here is actually to take care of proper maintenance. So that has been also true prior to COVID-19. Proper maintenance to avoid that that the property has some severe issues or malfunctions that can cause injuries. That we have improved accessibility and of properties, so inclusion of all kind of, so to say, population, proximity to public transport. The property needs to be embedded into the public space, so that it forms part and is not, so to say, something that does not belong to the specific district. And of course, one of, so to say, the more recent developments is the introduction of green leases, so that we align the interests, or the industry aligns the interests of tenants as well as of landlords with regards to their carbon dioxide footprint, or with regard to achieving their sustainability goals. And so to say, defining within the contract that both parties have to take or bear their fair share in achieving this. So with penalties for both sides of the contract. So, and if we achieve that, in the end, we'll have a brighter picture from a credit risk perspective. So how we actually look at this from a credit risk perspective, we look at the flexibility of the property stock. So is it really able to deal with population increase? So to give an example, for residential real estate corporates, we look at the existing availabilities of properties where they can easily add some additional stories, also levels, so that would actually benefit the overall efficiency of the property stock, or if the property company can actually deal with the change in consumer behavior. So also an example for a retail company, maybe it has a department store in the middle of the city, and how easily it can transform parts of that department store into inner city logistic, because it's more and more requested that we have, so to say, last mile hubs that are close or in the proximity to their customers. This is one first thing we look at. The second thing we look at here is if the company really incorporates a public interest. So if there is a focus on public health, on social equity and environmental awareness, and if the company is really able to do that, so the two things, in the end it will be beneficial, because it will be beneficial to achieve the ultimate goal, to prolong building's life cycle on one hand. On the other hand, it could support property values, if not increase, and it reduces operational as well as capital expenditure. And last but not least, we touch base on regulation. So as I said, regulation is really interlinked, even more interlinked with the other two than other factors. So the result actually of the challenges described before, to address the shortcomings of the real estate industry in addressing climate change or sustainability is regulation, because regulators feel the need to actually steer the market in a behavior towards a behavior that satisfy their targets or goals. We do not judge whether or not a specific regulation seems to be appropriate. That's not our business, but we acknowledge its impact on the company's cash generation as well as on its operational license. So whether or not there is a risk attached to that regulation. And if we talk about regulation, we can see that there has been a lot that has been done. More recently, so to say, the introduction of the EU taxonomy that actually should provide a more level play field for investors into sustainable products, because it provides a EU-wide uniform classification system for sustainable economic activities. And paired with that, but much longer in place already, is the Energy Performance of Buildings Directive by the EU. So, as I said, there is regulation on a broader level, but there's still a fragmentation on a nation-by-nation or country-by-country basis. So actually this directive supports the goal of the reduction of CO2 emissions and progress towards zero energy buildings by 2050. And it has to be implemented on a country-by-country level. And thus, to say, we see some slight different angles within every country with regard to how to achieve and when to achieve. What was more or less very prominent in the media, aside, so to say, those environmentally challenges we're facing, as a topic, so to say, of supply-demand imbalance, especially if it comes to residential real estate and the letting market. So there is a lot of discussions about rent control, whether or not they're achieving their goal or not. As I said, it's not our job to judge. And we see that there are a lot of regulated markets in the European Union. On the one hand, that's positive because it helps to de-link the rental cash flow from the development of the consumer price index or of the economy to a certain extent. So you have more stable, more visible cash flow. And on the other hand, could also overshoot. Like, for example, the rent freeze that was introduced in Berlin, but that was judged to be unconstitutional. So because as an effect, it limits really even more the supply for new residential apartments, or the supply in general for the market. But nevertheless, this will be one of the big themes in the future, how to actually deal with the shortcomings if it comes to residential housing. Also having in mind that there will be an increasing share of population moving to urban areas. And of course, we do not have a shortcoming of housing on average. There is more, so to say, within the shortcomings more focused on cities where we have a high influx of people. And last but not least, as I said, financing all these efforts is key actually to achieve all its goals. Yeah, there has been a lot of work being done, and the main, so to say, thing here is the Capital Markets Union. That is a target of the European Union to get to the money flowing across the EU, yeah, to benefit actually all stakeholders here. And parts of that, of course, are Solvency II, as well as the Pan-European Personal Pension Product Regulation, because what they are doing, or what they are, to say, supporting, is investments also to real estate. So they provide a specific leeway to investors from the insurance companies or pension funds to increase their share in real estate across Europe. And that's good because in the end, all hinges on the sufficient financing of all the measures that needs to be taken. And in the end, so to say, if assessing the risk regards regulation, what we look at is really whether a company is able to weather these changes in regulations it is exposed to, and how well it is prepared. And if it is not well prepared, and if it is not good in its setup, it could have an impact on the cost of money. Yeah, so it becomes more expensive. It could impact non-discretionary capital expenditure or just expenditure, as well as the cash generation. So these three items are, so to say, the result if you fail to, so to say, operate properly under the regulatory framework you need to operate with. And to summarize, in the end, so to say, the main things, as I said, property companies need to look at are the climate change, the sustainability of their property stock, as well as the regulatory environment. Thanks for your...
Thank you, Philippe, for a very comprehensive presentation, as usual. We've got a couple of questions here from our listeners today. The first one is, what do these ESG considerations mean for residential property yields?
So ESG consideration for residential property yields. The problem here is, if it comes to say, or if this question targets the achievable yields for residential properties, my personal view is that, given, so to say, the high need of investment, especially into that kind of property type, because most of the properties are rather, so to say, old, and it will have, so to say, negative impact on yields. So yields are going down, especially as companies will get used to being exposed to less returns on their investment. Yeah, this is to say the downside. On the other side, if they really invest into their portfolio and make it to say comply with the ESG goals of the specific jurisdictions they're operating in, it will benefit their stable cash flows, especially in the residential environment, as well as, so to say, avoid more regulatory scrutiny if it comes, so to say, to not addressing these ESG goals. So there will be some kind of payoff. Yeah, you pay off, or the balancing will be to accept low yields on the one hand, on the other hand, for to have more stable or more longer cash flow production of the property stock.
Thank you. And we time perhaps just for two quick final questions. Another one here is, you've talked a lot about the environment and social factors. What about governance and the implications there for real estate?
So generally, governance, at least is how we see it, is an indication of how well a corporation is controlled and directed to the extent that it's, so to say, complies with the interests of all stakeholders, including the payment of debt, etc., PP, not being exposed to bribery and fraud. So if we took it with that general view, that applies actually to all industries. So there is nothing that is specific for the real estate industry. So the impact of governance is as such, so to say, we just look at how a company is, if it has a proper governance in place, and as such, so to say, the impact of governance is either neutral or negative. So because we expect companies to have proper governance in place. And if you're really interested, so to say, in what we look at, if we assess governance, you can either, so to say, reference to our umbrella methodology, so the corporate methodology, where we laid out the specific general themes we look at, or also to the research piece you can find if you click on the link here, where we have, so to say, the same setup for all the industry if it comes to addressing governance issues under the ESG framework.
And perhaps a final question, Philippe. This is on cash flow. If you had to highlight one or two examples of ESG factors which affect real estate companies' cash flows, which would you choose?
So as I said, most of these non-financial KPIs are more of a qualitative nature, and you cannot really see, at least, or you cannot observe in the short term, their direct impact on cash flow. So just to give you an example, I read through the annual report of a company, and they said, okay, yeah, we're so happy we replaced all our light bulbs with LED light bulbs, yeah, and in the end, that provides us with savings of 70,000 euros in running costs. So let's have in mind that this company produces roughly 400 million in EBITDA, so it's not really important. And so what we try to address here is really have a more forward-looking approach and to try to assess whether or not these investments and factors might lead to improved cash flow or not. And to give an example, I guess the most obvious would be the consumption of natural resources, so water, energy, or whatsoever. And what we look at there to assess it, because we need to have it measurable somewhat, yeah, even if we cannot measure right now what it means in the end with regard to the cash flow profile or the credit quality. Yeah, we need to have some measurable items. So what we look at is the portfolio share of certified buildings, yeah, the energy consumption and energy mix, both, so to say, on an absolute scale and a like-for-like scale, the water consumption, as well as, for example, the portfolio share of green leases. And how does this now, so to say, impact the cash flow or the credit profile? As I said, maybe it's a long-term impact we will see, yeah. And the high share of certified buildings, for example, could generate more stable cash flow and supports property values, yeah, that match market criteria or a regulation-driven demand from tenants and investors. Investors might be tempted to invest in, or are tempted to invest into certified buildings compared to non-certified buildings. And also reduced total energy and water consumption lowers the service charges. So it could potentially contribute to higher operating income and cash flow in the end. Yeah. So if you lower the service charge, the tenant has, let's say, some additional headroom to pay a higher net cold rent. And for green leases, of course, if the tenant and the landlord are aligned with regard to achieving the sustainability efforts they're undertaking, they could ultimately together reduce the operating expenditure for both of them. So actually, these are, so to say, the potential results. But as I said, the real impact will be rather observable in the medium to long term, not in the short term.
Well, on that note, Philippe, I think it's a good time for us to end. Thank you so much for your time, and thanks to everyone who's joined the call today for your time. Before you go, I should just mention that you'll be getting a very short questionnaire with which we're looking for some feedback on today's call. It'll take you less than a minute of your time to fill it out. Please have a look. And otherwise, just leaves me to say goodbye and hope to see you again soon on a Scope Ratings webinar. Thank you.
Bye-bye.